After clocking in nearly 10% returns in Samvat 2079, benchmark Sensex and Nifty indices will usher into the new Samvat next week against a dreary global backdrop. A swift rally from April this year, helped by a domestic rate hike pause and easing inflation, has come to a standstill amid a new global war and slowdown in some major economies. So how will the equity market play out in Samvat 2080? It will be a mix of volatility and strength, analysts say.
I think the Samvat 2080 will be a tale of two halves, with the first half being a one of volatility in the run-up to elections, and the second half is when we'd see the underlying strength in the economy and the growth in earnings that we're expecting to reflect in strong returns from markets. I think one big concern has been what will the US Fed be doing. We believe that while the rate cycle has been very steep, we are towards the fag end of this rate cycle. And while we will have higher rates for longer, which should impact the US economy a bit more, in India.
On markets returns, Sunil Nayati, Managing Director of Swastika Investmart, sees Nifty topping 24,000 in Samvat 2080 if the current government secures a third consecutive win in the national polls. This is a 24% upside for the Nifty index from current levels. Sinha Roy of ICICI Prudential Life meanwhile expects mid-teen returns from the Nifty 50. Among sectors, FMCG stocks will find favor amid volatility ahead of elections, while post-election policy certainty will lift domestic cyclicals, analysts say.
Domestic cyclicals should start doing well in the second half, driven by earnings growth and also driven by policy certainty post the elections. And I believe that sectors like financials and cement could do well, given that they are the biggest beneficiaries of the current capex cycle and the re-leveraging of the economy that is happening. And eventually, as the US market also starts to recover, we should expect IT to do well.
That said, the recent foreign outflows do not worry market experts much, as rate cuts in the US will prompt repositioning of funds from US debt to domestic equities.
I would say such kind of an outflow would have crashed the market substantially, but we did not crash and the market is resilient. It was majorly due to the domestic investment which has happened into the Indian stock market. So if you ask me, to my sense, we are in an early cycle of a bull run. There's a lot of money which is sitting into the bond market of US, because presently there the interest rate is hovering around 5.5%, which they have never seen. So a lot of money is flowing into the bond market of US. But when the interest rate will start declining, that money will start flowing into the emerging countries like India.
Thus, market experts suggest investors stay put in the Indian market, as the underlying economic strength and earnings cycle will keep equities afloat in the long run. Today, on November 10, investors will track India's IIP and Forex reserves data after the market hours.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's moving from employee to employer. Business Standard.